Picture this for a second. You're sitting comfortably, watching the market, thinking everything is fine because the numbers on the screen haven't changed much, the price looks stable, the chart looks normal, nothing feels urgent, and that's exactly the problem, because while you're relaxed, someone has already removed most of the support underneath the system. The structure hasn't fallen yet, but it's already broken. The only thing missing is weight. And when that weight shifts, there will be no warning. That's exactly where the silver market is right now. Most people think a crisis starts when prices explode higher or crash lower. That's wrong. Real crises begin quietly when the price lies, when the system pretends nothing has changed, even though the physical reality underneath it already has. And today, I need you to understand something very clearly. The silver market is no longer pricing reality. It is pricing a fiction that cannot survive much longer. Something happened on January 1st, 2026 that fundamentally altered global silver supply. Not in theory, not eventually, immediately. China implemented an export licensing system that effectively removed roughly 250 million ounces of silver from the global market overnight. No gradual phase in. No long transition period. One day the supply existed on paper, the next day it didn't. And yet, here we are watching COMEX silver trade around the low 70s as if nothing changed. That disconnect is not a coincidence. It is a trap. Let me explain why this matters, because most investors never look past the price on the screen. They assume that if the price hasn't moved yet, the risk must not be real. But markets don't break when everyone sees the problem. They break when the problem becomes impossible to hide. The COMEX silver market is built on a very specific assumption that if enough people ever demand physical delivery instead of cash settlement, the metal will be there. That assumption is what gives paper contracts credibility. Without it, the entire structure collapses into a confidence game. To understand how fragile that structure is right now, you have to understand how COMEX inventory actually works. There are two categories of silver stored in COMEX-approved vaults, eligible and registered. Eligible silver simply meets exchange standards and sits in approved warehouses, but it is not committed to delivery. Registered silver is the critical category. That is the metal that has been pledged and is legally available to settle futures contracts if delivery is demanded. Registered silver is the backbone of the paper market. It is the physical anchor that makes the leverage tolerable. In 2020, COMEX had over 100 million ounces of registered silver. That provided a reasonable buffer. Today, registered inventory has collapsed to roughly 31 million ounces. That is not a typo. More than 2/3 of deliverable silver is gone. Now compare that to open interest. Each silver futures contract represents 5,000 ounces. Current open interest represents claims on roughly 140 million ounces of silver. Do the math slowly, because this is where the illusion breaks. For every ounce of registered silver available for delivery, there are more than 4 paper claims against it. That ratio has never existed in COMEX history without forcing emergency action, not once. In 1980, when the Hunt brothers exposed the system by taking delivery, the ratio never even reached this extreme before the exchange changed the rules. In 2011, during silver's run to $49, the paper-to-physical ratio was significantly lower than it is today, and COMEX still responded by raising margins 5 times in 8 days to force liquidation. Today, we are far beyond those stress levels, and the price is still pretending everything is normal. That alone should tell you something is wrong. Now add China into the equation, because this is where the situation shifts from unstable to unsustainable. China is the world's largest silver refiner. In 2025 alone, Chinese refiners processed roughly 280 million ounces of silver. Historically, that silver flowed into global supply chains with minimal friction. Western manufacturers depended on it. Traders assumed it would always be available. Futures markets priced it in as if it were guaranteed. The new Chinese export licensing system changes that assumption completely. On paper, the policy looks administrative. In reality, it is exclusionary. Around 90% of Chinese refiners are small to mid-sized operations. They do not have the legal teams, regulatory infrastructure, or government relationships needed to navigate complex export approvals. As a result, only a small fraction of Chinese production is now legally exportable. The net effect is brutal. Roughly 250 million ounces of annual silver supply just disappeared from international markets. Not delayed, not reduced, removed. Meanwhile, global industrial demand has not declined. Solar manufacturing alone consumes over 130 million ounces per year. Electronics Electric vehicles, medical devices, defense systems, and water purification add hundreds of millions more. Industrial demand does not respond to futures prices in real time. Factories don't stop production because a chart looks bearish. They buy what they need or they shut down. This is where the paper market and the physical market collide. If you want proof that the physical market already understands what the paper market is denying, look at Shanghai. In the days leading up to China's licensing enforcement, physical silver premiums in Shanghai exploded. Buyers were paying the equivalent of $80, $90 per ounce, while COMEX paper silver traded in the low 70s. That is not a normal arbitrage gap. That is a structural disconnect. When physical buyers are willing to pay double-digit premiums for immediate delivery, it means metal is scarce where it actually matters. When futures traders are still shorting paper contracts at suppressed prices, it means they are betting that most buyers will never ask for delivery. That bet only works until it doesn't. Here's the part most investors do not think through. Industrial buyers do not have the luxury of rolling contracts forever. At some point, they must secure metal. And when Chinese supply chains fail, they look elsewhere. That elsewhere is COMEX. If even 20-25% of current futures holders demand delivery instead of cash settlement, registered inventory goes to zero, not low, zero. And once that happens, price becomes irrelevant. The exchange is forced to choose between honoring contracts or protecting the system. We already know how that choice plays out because history is very clear. When physical delivery threatens the paper structure, exchanges change the rules. They raise margins. They impose position limits. They force cash settlement. They do whatever is necessary to prevent a visible default. That is not a theory. It is documented behavior. In 1980, the rules were changed mid-game. In 2011, the same thing happened. The goal was not fairness. The goal was survival. What makes this moment different is that the shortage is not speculative. It is structural. You cannot margin call China into exporting silver. You cannot regulate industrial demand away overnight. And you cannot print metal. That is why institutional behavior has shifted so dramatically. According to CFTC data, JP Morgan, the single largest player in silver derivatives, flipped from a massive net short position to a massive net long position in late 2025. This was not a small hedge adjustment. It represented a swing of hundreds of millions of ounces and tens of billions of dollars in exposure. Banks do not make moves like that because of sentiment. They make them because the risk profile of the system has changed. While retail investors are still arguing about whether silver is overbought or oversold, institutions are positioning for a structural repricing event. And this brings us to the real risk that almost nobody wants to talk about. When physical scarcity collides with paper leverage, the first thing that breaks is trust. If futures contracts no longer guarantee delivery at the quoted price, the price itself becomes meaningless. It becomes a reference number, not a clearing mechanism. That is when you see forced cash settlement. That is when you see emergency rule changes quietly posted after hours. That is when liquidity injections start appearing in the repo market to keep counterparties solvent while the system absorbs losses. None of this looks dramatic at first. It looks technical, boring, administrative, until suddenly it isn't. The silver market right now is not in equilibrium. It is in denial. The price is telling you one story. The supply chain is telling you another. And those two stories cannot coexist much longer. This is not about predicting a specific price tomorrow or next week. It is about understanding that the structure holding the market together is weaker than it appears. When the weight finally shifts, when enough buyers demand metal instead of paper, the adjustment will not be gradual. It will be violent. In the next part, we are going to look at the exact pressure points where this system breaks, the timelines that matter, the inventory math institutions are watching, and the scenarios that determine whether this ends in a controlled repricing or an outright credibility crisis. Because once you see those numbers clearly, you stop asking whether silver is cheap or expensive at 71. Now you start asking how long the illusion can last, and the answer to that question is coming much faster than most people realize. Now let's slow this down and look at the mechanics, because this is where most people lose the plot. Markets don't fail because of drama. They fail because math stops working. And right now, the math behind silver is breaking in ways that cannot be patched with optimism, commentary, or short-term price suppression. Start with inventory behavior, not headlines. COMEX registered silver has been draining steadily, but the pace matters more than the headline number. Throughout December, withdrawals averaged just over 2 million ounces per week. That alone would be concerning in a normal environment. But this isn't a normal environment. Those withdrawals occurred before most industrial buyers fully internalized the implications of China's export licensing. They occurred while many procurement teams still believed delays were temporary. They occurred while futures traders were still comfortable rolling positions forward instead of demanding metal. That context matters because behavior changes fast when supply risk becomes undeniable. Procurement teams don't debate ideology. They respond to delivery timelines. When a 2-week delivery becomes 8 weeks, alarms go off. When export licenses are denied instead of delayed, contingency plans activate. When Shanghai premiums spike and stay elevated, it signals that the physical market has already repriced risk, even if the paper market hasn't admitted it yet. This is how pressure builds invisibly. It doesn't show up as panic selling. It shows up as quiet decisions to secure supply early, and those decisions translate directly into delivery demands. Here's the uncomfortable truth. The COMEX system only works if most participants agree to keep playing the paper game. The moment too many players ask for the underlying asset, leverage becomes a liability. That's not unique to silver. It's a universal rule of fractional systems. Right now, the silver market is relying on the assumption that delivery requests remain manageable. That assumption is increasingly fragile. Look at the calendar. Early January is not just another week. It's when institutional rebalancing, industrial restocking, and annual procurement cycles converge. Large allocators don't trickle into positions. They move in size according to schedules. When those schedules collide with constrained supply, price becomes secondary to access. This is where things get dangerous for the paper price. Consider what happens when a large industrial buyer decides not to roll futures anymore. They don't announce it on social media. They notify their clearing firm that they intend to stand for delivery. That request cascades through the system quietly, legally, and irreversibly. It turns a speculative instrument into a physical obligation. Now, multiply that behavior across multiple buyers who all reach the same conclusion independently, that waiting increases risk. That's how delivery pressure accelerates nonlinearly. This is why inventory drawdowns rarely remain linear. They start slow, then suddenly they aren't. The system's response to that pressure is predictable because we've seen it before. Exchanges don't like visible stress. They prefer controlled outcomes. When pressure rises, they deploy tools designed to reduce participation. Margin hikes are the most effective of those tools. Margin is not a risk management detail, it's a behavioral weapon. When margins rise, leveraged traders are forced to reduce exposure or inject capital. That shrinks open interest. It reduces delivery risk. It also creates selling pressure that pushes price down, reinforcing the illusion that supply is ample. This is how price can fall, even as physical scarcity increases. That paradox confuses retail investors every time. They see lower prices and assume risk has decreased. In reality, lower prices in this context are often a symptom of stress, not relief. The reason this mechanism worked in the past is because the demand being suppressed was speculative. In 1980 and 2011, the marginal buyer was leverage dependent. When rules changed, demand evaporated, prices collapsed, and the system survived. But this time, the marginal buyer is not a trader chasing momentum. It's an industrial user protecting production continuity. You cannot margin call a factory into not needing silver. You cannot regulate away physical necessity. That distinction is everything. When margin hikes fail to eliminate demand, they expose the system instead of stabilizing it. They push demand out of the exchange and into alternative channels. That's when price discovery escapes official control. You can already see early signs of this in the behavior of physical premiums, delivery lead times, and off-exchange transactions. None of that is reflected cleanly in futures prices, but it doesn't need to be. It only needs to persist. Another overlooked pressure point is collateral. Silver is not just a commodity. It's used indirectly across the financial system as part of structured products, hedges, and cross-asset exposures. When price volatility increases and physical availability decreases, collateral assumptions get questioned. That's when liquidity tightens in places most retail investors never look. Watch the repo market, watch short-term funding stress. When you see sudden increases in overnight liquidity operations, it's rarely about one asset in isolation. It's about balance sheets adjusting to risk that wasn't supposed to materialize. This is where confidence becomes fragile. The futures market operates on trust. Trust that contracts settle smoothly. Trust that delivery mechanisms function. Trust that extreme outcomes will be avoided through orderly intervention. Once that trust starts to erode, participants behave defensively. Defensive behavior amplifies volatility. And here's the part that almost nobody wants to say out loud. Forced cash settlement is not a theoretical risk. It's written into the rule book. The language exists specifically to deal with situations where physical delivery becomes impractical. That word is flexible. It gives the exchange discretion. From a systemic perspective, forced cash settlement protects clearing members. From a contract holder's perspective, it breaks the promise. If that line is crossed, even quietly, it changes how participants value the entire market. A contract that cannot guarantee delivery is no longer equivalent to the asset it references. It becomes a derivative of convenience, not ownership. That distinction matters deeply when scarcity is the core issue. The institutions closest to this risk understand it. They don't need dramatic headlines to act. They read inventory reports, they track withdrawal rates, they model delivery ratios, and they position accordingly. This is why shifts in institutional positioning deserve attention. When large players move decisively, it's rarely about short-term price action. It's about structural asymmetry. They are not betting on volatility. They are hedging against system outcomes. Retail narratives tend to focus on manipulation versus fundamentals. That's a false dichotomy. The real issue is structural fragility. A system can be manipulated precisely because it is fragile. When that fragility reaches a threshold, control mechanisms stop working as intended. Another misconception that needs to be addressed is the idea that shortages immediately result in price spikes. In leveraged markets, the opposite often happens first. Price is pushed down to discourage participation and buy time. That is not bearish in context, it's defensive. Think of it as a pressure valve. Lower prices reduce speculative interest, shrink open interest, and slow delivery demand temporarily. The goal is not to reflect reality, it's to delay it. The problem is that delay doesn't solve structural deficits, it just compresses them. Meanwhile, the physical market continues operating on its own logic. Buyers pay what they must to secure supply, sellers hold inventory if replacement risk is high, premiums widen, availability tightens. None of this requires futures prices to move immediately. Eventually, the divergence becomes too large to ignore. At that point, something gives. Either futures prices reprice sharply upward to reflect scarcity, or the market formally decouples. With physical trade happening at prices that futures no longer represent. Both outcomes undermine confidence in the existing pricing mechanism. This is why timelines matter more than targets right now. The question is not whether silver should be higher. The question is how long the current structure can absorb delivery pressure without breaking credibility. Based on current withdrawal rates alone, the window is not large. Based on accelerating industrial awareness, it is likely shorter. Based on institutional rebalancing cycles, it is compressed further. None of this requires panic, it requires attention. If you understand that markets transition from stability to instability quietly, you stop waiting for obvious signals. You stop expecting the price to warn you. You start watching behavior. Who is taking delivery? Who is reducing exposure? Who is increasing it quietly? Where are premiums rising despite falling spot prices? Where are lead times stretching? Those signals matter far more than daily candles. The silver market right now is in a phase where surface calm masks underlying strain. That is the most dangerous phase because it rewards complacency and punishes preparation. Price at 71 does not mean safety. It means denial is still functioning. And denial in markets always has an expiration date. At this point, the most important thing to understand is that markets do not resolve structural stress politely. They don't send invitations. They don't wait for consensus. They resolve stress in ways that maximize confusion, punish late recognition, and protect those who positioned early. That is the phase the silver market is moving toward now. The mistake most people make is assuming the outcome will look dramatic from the start. They expect a headline event, a sudden halt, or an obvious announcement. But structural repricing rarely begins that way. It begins with small rule changes, subtle behavior shifts, and quiet signals that only make sense in hindsight. Think about what has to happen next, not emotionally, but mechanically. As physical pressure builds, the exchange has only a few tools available. None of them create silver. They only redistribute stress. Margin increases reduce leverage. Position limits reduce participation. Cash settlement eliminates delivery obligations. Liquidity injections keep clearing members solvent, while losses are absorbed elsewhere. Every one of these tools is designed to protect the system, not the contract holder. That distinction matters more than most investors want to admit. If the exchange raises margins aggressively, leveraged longs are forced out. Price can fall sharply, even as physical scarcity worsens. That creates psychological damage. People assume they were wrong. They sell at exactly the wrong moment. This is not accidental. It is how stress is managed in leveraged markets. But margin pressure does not eliminate industrial demand. It only delays its impact on price. If the exchange leans toward cash settlement, the signal becomes even clearer. A market that settles cash when physical delivery is requested is admitting, quietly, that price no longer clears supply and demand. From that moment forward, futures prices lose their authority as a reference point for the real economy. Once that authority is questioned, behavior changes fast. Large buyers stop trusting the screen price. They negotiate directly. They lock in long-term contracts at premiums. They bypass exchanges entirely. Those transactions don't show up in futures charts, but they reshape the market underneath it. This is how parallel pricing structures form. At first, the divergence is tolerated. It's just a premium. Then the premium grows. Then delivery delays lengthen. Then futures liquidity thins. Eventually, the paper price becomes a lagging indicator, not a leader. By the time that realization becomes widespread, the repricing has already happened where it matters. This is why institutions move early. They don't need perfect timing. They need asymmetry. They need to be positioned before the crowd understands that the rules of the game are changing. And make no mistake, the rules always change when scarcity threatens leverage. One of the most dangerous assumptions retail investors make is that exchanges exist to enforce fairness. They don't. They exist to maintain continuity. Continuity of clearing, settlement, and systemic confidence. When fairness conflicts with continuity, fairness loses every time. That is not cynicism. It is design. So, the real question is not whether silver is undervalued. The real question is how the transition from paper equilibrium to physical equilibrium unfolds, and who absorbs the cost. There are only three ways a structural shortage resolves. The first is demand destruction. Prices rise high enough that some users are forced to reduce consumption, redesign products, or delay projects. This is slow, painful, and politically unpopular when it affects strategic industries. The second is supply substitution. Alternatives are developed, scrap recovery accelerates, and new sources are brought online. This requires time, capital, and sustained high prices. It does not happen at suppressed price levels. The third is inventory depletion. Existing stockpiles are drawn down until they are gone, at which point price must adjust violently because there is nothing left to buffer demand. Right now, the system is moving through the third path. Inventory is the shock absorber. Once it's gone, volatility explodes. The uncomfortable reality is that suppressed prices accelerate depletion. They encourage consumption and discourage conservation. That makes the eventual adjustment larger, not smaller. This is why cheap prices during structural shortages are dangerous, not comforting. As inventory tightens, every additional ounce becomes more valuable, not because of speculation, but because replacement risk increases. Buyers stop thinking in terms of price and start thinking in terms of availability. That mental shift is irreversible. Once availability becomes the priority, price follows violently. At the same time, paper participants face a different reality. Volatility increases margin requirements. Volatility increases risk limits. Volatility increases scrutiny. Participation declines, liquidity thins. Thin liquidity amplifies price moves in both directions. This is why late-stage transitions feel chaotic. The market swings sharply without clear narrative justification. Confidence erodes. Signals contradict each other. People freeze. That confusion is not a bug. It is the environment in which structural repricing occurs. Another critical point that needs to be understood is that timing precision is a trap. People want dates. They want certainty. They want to know exactly when the break happens. Markets do not reward that mindset. They reward preparedness. Structural transitions unfold across windows, not moments. Pressure builds, stress leaks, then a catalyst accelerates recognition. That catalyst can be small, a failed delivery, a rule change, a premium spike, a funding event, something that forces attention. By the time it's obvious, positioning has already shifted. This is why waiting for confirmation often means paying the highest price, emotionally or financially. Now let's address the emotional side, because this is where most people fail, even when they are directionally correct. Volatility creates doubt. Doubt leads to second guessing. Second guessing leads to reactive decisions. Reactive decisions transfer wealth. The market's goal during transitions is not to inform you. It is to exhaust you. Sideways movement after stress is particularly dangerous. People mistake it for resolution. In reality, it is often redistribution. Strong hands accumulate quietly. Weak hands get bored, frustrated, or scared and exit. The silence between moves is where positions change hands. If you are constantly looking for excitement, you will misinterpret calm as safety and volatility as danger. In reality, volatility is often information, and calm can be concealment. The silver market right now is not calm because it is healthy. It is calm because stress is being managed, not resolved. That distinction changes how you should think. You should, instead of asking, where's the price going tomorrow? The better question is, what behavior would signal that the structure is failing? Those signals are not found in opinions. They are found in mechanics. Watch inventory, not headlines. Watch delivery behavior, not sentiment. Watch premiums, not spot prices. Watch rule changes, not press releases. Watch liquidity operations, not daily candles. When multiple stress indicators align, the resolution accelerates. Another mistake is assuming that resolution must be explosive upward. It doesn't. The first phase can be disorderly, downward, or sideways. Price can be pushed down even as risk increases. That is not contradiction, it is strategy. Price suppression buys time. It does not fix math. Eventually, suppression increases the magnitude of repricing. The longer reality is delayed, the sharper the adjustment. This is why late recognition is punished. People who wait for proof often become forced participants instead of voluntary ones. The goal is not to predict a top or bottom. The goal is to avoid being forced. Forced selling, forced settlement, forced capitulation. These are outcomes, not strategies. When you understand that, your behavior changes. You stop chasing, you stop panicking, you stop assuming the screen price tells the whole story, you start thinking in terms of system dynamics, and system dynamics right now favor volatility, not stability. The silver market is transitioning from a leverage-dominated regime to a scarcity-dominated regime. Those transitions are never smooth, they are contested, they involve resistance, they involve rule changes, they involve narrative battles, but they always resolve the same way. Physical reality asserts itself. It does not do so on a schedule. It does not do so politely. It does so when delay becomes impossible. At that point, price is no longer debated. It is discovered. Most people will only understand what happened after it's over. They will look back and say the signs were obvious. In real time, they rarely feel that way. That is why this phase feels uncomfortable. That discomfort is information. The market is not asking for your confidence. It is testing your patience and discipline. If you can sit through ambiguity without forcing conclusions, you give yourself an advantage. If you need constant confirmation, the market will exploit that need. This is not about optimism or pessimism. It is about realism. Scarcity does not negotiate. Leverage does. And when those two collide, leverage loses. The only remaining question is how much damage occurs in the process and who absorbs it. That answer depends entirely on behavior, not just institutional behavior, but individual behavior. Those who understand the structure will not be surprised by the outcome. They may not time it perfectly, but they will not be confused by it. B. Those who rely solely on the screen price will feel blindsided. Right now, the silver market is offering a rare window, time to think clearly before stress becomes visible. That window does not stay open indefinitely. When it closes, decisions become reactive, not deliberate. And markets always reward the deliberate over the reactive. The structure is strained. The math is tight. The signals are present. What happens next will not be gentle, but it will be logical. And logic in markets always reasserts itself in the end. At this stage, the most important thing to understand is that markets do not collapse loudly at first. They collapse quietly through confidence erosion, rule changes, and behavioral shifts that only make sense after the fact. By the time the headline catches up, the opportunity is gone and the damage is already done. This is where we are now. The silver market is no longer operating in a normal discovery environment. It is operating in a containment environment. The goal is not to let price reflect reality. The goal is to manage stress long enough for positioning to adjust and risk to be transferred. That is why everything feels contradictory. You see tight physical supply, but muted prices. You see strong long-term fundamentals, but violent short-term moves. You see institutions positioning aggressively while retail is being shaken out. That is not confusion, that is orchestration. And here's the part most people miss. Orchestration only works until participation changes. The moment enough participants stop playing the paper game and start demanding real outcomes, the entire framework shifts. This is why delivery behavior matters more than opinion. This is why inventory matters more than narratives. This is why rule changes matter more than charts. Because charts reflect what already happened. Structure tells you what must happen. Right now, the structure is under pressure from three directions at once. First, supply constraint. Not theoretical, not temporary, but administrative and structural. Once supply is removed by policy, it does not respond to price signals in the short term. That means higher prices do not immediately create more metal. That is the definition of inelastic supply. Second, demand rigidity. Industrial demand is not speculative. It does not disappear because price volatility increases. It slows only when substitution becomes economically viable or when production halts. Neither happens overnight. Third, leverage fragility. Paper markets rely on confidence that contracts can be honored under stress. When that confidence weakens, participation changes. And when participation changes, liquidity evaporates. These three forces do not cancel each other out. They amplify each other. The longer price remains artificially compressed, the greater the pressure that builds behind it. The system can delay repricing, but it cannot eliminate it. That is why experienced market participants focus less on if and more on how. How will repricing occur? Who will absorb the cost? Who will be protected? Who will be forced? History gives us the answer, even if the asset changes. When systems are stressed, rules are rewritten to protect clearing members and large counterparties. Losses are socialized downward. Optionality is removed from weaker hands. Participation narrows. The people hurt the most are not those who were wrong, but those who were right too early and overexposed. This is why discipline matters more than conviction. Strong convictions with weak positioning lead to forced exits. Moderate convictions with strong positioning survive volatility. Survival is underrated. Right now, survival means understanding that volatility is not a verdict. It is a filter. It removes leverage, impatience, and emotional decision-making. What remains afterward is what drives the next phase. This is why markets often feel cruel. They are not designed to reward intelligence alone. They reward structure-aware behavior. If you are constantly reacting, you are providing liquidity to someone who planned ahead. If you are constantly seeking certainty, you will always arrive late. The people who benefit most from structural transitions are not those who predict the exact moment of the break. They are those who recognize the setup early and refuse to be shaken out before it resolves. And yes, resolution can take longer than feels comfortable. That is intentional. The market will test your patience before it rewards your understanding. It will show you fake breakdowns. It will show you fake recoveries. It will try to make you abandon your framework and replace it with emotion. That is the real battle. Not price versus value, but discipline versus impulse. So what does a rational approach look like from here? It means staying focused on signals that matter and ignoring noise that doesn't. It means watching how inventories behave during stress, not how price behaves during headlines. It means paying attention to delivery rules, margin changes, and settlement language, because those reveal where pressure actually is. It means understanding that sideways action is not inactivity. It is redistribution. And most importantly, it means accepting that you do not need to act constantly to be correct. In periods like this, doing less is often doing more. Let the system reveal itself. Let the weak hands exit. Let the institutions finish repositioning. Let the stress surface. When the transition completes, it will not ask for your permission. It will move quickly, decisively, and without apology. By then, the narrative will flip. The same voices that dismiss the risk will explain it confidently in hindsight. The same analysts who said nothing will suddenly sound certain. That is how these cycles always end. The goal is not to be impressed by that moment. The goal is to already understand it. Silver is not unique in this regard. It is simply one of the clearest case studies of what happens when real assets collide with leveraged abstractions. The story is bigger than one metal. It is about scarcity in a world that priced abundance. It is about systems built on trust, meeting limits, built on physics. It is about paper promises encountering real-world constraints. Those themes are not going away. They are expanding. What happens next in silver will echo elsewhere. Different markets, different assets, same mechanics. If you can understand this here, you will recognize it again. That recognition is the real edge. Before we wrap this up, one thing needs to be said clearly. Nothing discussed here is a guarantee. So markets are probabilistic, not deterministic. Risk always exists. Outcomes are never owed. But probability favors those who respect structure over those who chase noise. And right now, the structure is speaking very loudly, just not in the places most people are looking. If this breakdown helped you see the market differently, do not keep it to yourself. Share this video with someone who is still relying only on headlines and price screens. If you want continued analysis that focuses on structure, mechanics, and what institutions are actually doing, not hype, not panic, subscribe to the channel and turn on notifications. These transitions do not happen often, but when they do, they matter. Stay calm, stay disciplined, watch the structure. And remember, the market does not reward the loudest voice, and it rewards the most prepared mind.